There is an identifiable and documented phenomenon that occurs every 10 years or so where U.S. stocks will outperform international stocks, and then for reasons that aren't usually predicted in advance, that will rotate where international stocks will outperform U.S. stocks. We may be starting in such a period now. For the last 13 years or so, U.S. stocks have dominated growth in the world equity markets, but there seems to be some change of that going on right now. The point is not to time the shift, but the point is to understand that the shift occurs and that the prudent investor is one who invests globally at all times, not really having any advance notification as to when the shift will occur. Another good way to think about this is to think of something as simple as the chocolate chip cookie. I don't know about you, but growing up in my house, the smell of fresh-baked chocolate chip cookies was an anticipated and welcome phenomenon. And what was almost always the case is that the chocolate chip morsels that were used to bake those cookies were Nestle chocolate chips. The recipe was right on the package. Well, Nestle's a Swiss company, and I don't think we knew that or cared about that when those cookies were in the oven. It's also very possible, at least these days, that in making those cookies, you bought your other baking supplies at Trader Joe's, which interestingly is a German company, and you may have baked them or stored them in a Samsung refrigerator or oven, which of course is a Korean company. As investors, it's important to realize that many of the products that we use on a day-to-day basis are from companies that are headquartered all over the world. We don't limit our consumption to only U.S. companies, and so we shouldn't limit our portfolios to only U.S. companies. In fact, it completely makes sense in designing a portfolio to be participating in the great companies of America and the rest of the world. And doing so will maximize the potential of our investments. As I mentioned earlier, there is a rotation. We don't know when there's going to be a shift to underweight or overweight to U.S. or international. We just know that both of those asset classes grow through time. We just don't know at what time. And that's the primary argument for owning them all. Another thing that's interesting to note is we do know that America is the strongest economic engine in the world and has been for many decades. But America, over the last about 25 years, has never been the number one market in any particular year. It bounces around, and we don't know, again, ahead of time, which world market is going to be number one from year to year. And that's, again, another supporting argument for diversifying across all of them. I think it's important to keep in mind, because of different policies, different structures of law, different rights among countries, that there could be greater or lesser risk by investing abroad. But nevertheless, the opportunity is too strong to ignore, and to build in safeguards into a portfolio in order to gain that participation is a smart thing to do. So when you're thinking about designing a portfolio, just remember the chocolate chip cookie and include some international in your portfolio, because it's a sweet deal.